Good morning, ladies and gentlemen. Well, what a fun week. And not only because I got to get off this rock and have a bit of fun last night, but we rode the market all the way up at the beginning of the week. We sold very close to the top and we rode it all the way down. And then on Friday, we started riding it all on the way up. That is what volatility does and enables you to do. And that is why I have said for a long time, watch what volatility is doing, not where equities are trading, if you want to see what the markers ahead are. Now this is a weekly chart of the VIX. I could show you all kinds of spreads, but this is probably the most important and informative chart for the next few weeks. As you know, we've had these lines drawn for months, and they will be our guide as to what is going to happen in the months and weeks ahead. As soon as the market broke the 1608 area, it gave us a warning, a fair warning at the end of last week that things were not well. It closed above it. Our system said lighten up on equities, as we did. As soon as it broke 1980, it said this is going to get really nasty, lighten up some more, but look for trading opportunities. And as soon as it got to 43.05, it said reinstate. It traded 43.05 precisely as the market hit the low on Friday. So it works. This is a system that works for trading and works for investing. And let us now look at what it's saying lies ahead. Well, quite simply, the nearest period to it, the one with the best approximation in the past, has been the beginning of 2010 and the middle to end of 2011. All the other periods that we've analyzed don't come anywhere close to it. So really it is to be expected that we're going to have something approximating these two periods in history. And let's now have a look at what SPX did in those days. So we're looking for the beginning of 2010, that is this area here, and we're looking for middle towards end of 2012, and that is this area here. Both are consolidations within an uptrend, and both are very, very, very important lows, which once established were not challenged for ever really. Those were very important lows. What are we doing here? Well, we are correcting amazingly overbought levels on the weeklies. We never had a 90 RSI on the weeklies ever. As I kept on saying to you, we will not keep on trading above the top of the Bollinger Bands. There is something very wrong here. And we didn't. 2 weeks later, we have touched the line that I said we would be support. And in fact, we went through it looking for the next support, which happened to be the 200-day moving average, but it could easily have been 25.12. You see now that the weekly Bollinger Bands are closing, indicating that we are going to have a period of whip, very much like this period here. I would have thought that 27.20, 27.60 is going to be easily the top, and then we will probably try the bottom and undercut it once or twice before finding a bottom, real bottom, somewhere around 2500. This is a period that should take at least a couple of months, and then we will be ready for the next move. If you ask me, I think this is probably an ABC, and now we've had the A, we need to establish the B, and then we will need to establish the C, and that will be our correction, and then we're probably ready for another leg higher. I say this because none of the spreads that indicate long-term risk off are present. We will now examine those spreads, and you will see with me that we just do not have the preconditions necessary for a bear market. These were not bear markets. These were corrections within a secular uptrend. A bear market looked completely different, and I will now show you how, why, and when. This is SPY over gold. Not the most important risk on, risk off chart that we look at. In fact, it's way into the teens in terms of importance. But you can see it gives you a very good chart structure. The market is trading very comfortably within an ascending channel. All it's doing is getting too far away from the 200-day moving average, coming back towards it. That is what it's doing. If we now go back and have a look at the way that chart looked in 2007, you will see that it's a completely different look. It was a descending channel that we were in, and a bear market that it was actually telling you that we were in. So this is a completely different look, but we will now examine the top 5 risk on, risk off indicators. I just showed you this one because it's so different that it gives you the idea the best. I like SOX over FXY, so that's the semiconductor index over the yen, because it's extremely fast. It tells you extremely immediately if there is a problem with liquidity in the system. Well, ish, right? All it's done over the past couple of weeks is retrace to the 200-day moving average, and now we'll probably just trade around it. Should we undercut that low that we made on Friday, then we might be in trouble. But this is not yet a worrying look. And don't forget that this is by far the fastest risk on, risk off indicator. It's immediate, and even that one is telling you that we're not in a bad place. How did that indicator look at the beginning of 2008? This is 2007. It spent the whole year rolling over, trading under the 200-day moving average, and then in the beginning of 2008 it just collapsed. So it takes a long time for even the fastest indicator to give you warning. At the moment it is just not doing so, and therefore we can't be worried. XLP over XLY. Well, if this is a worrying look to somebody, I don't know why that would be. It is firmly in a risk-on move. XLP is coming down a lot faster than XLY. Basically, it's saying that fixed income and assets which produce dividends are not favored compared to growth assets, which are included in XLY. It's saying the economy is just fine. Consumer discretionary, which is 70% of the US economy, is doing just fine. Do not worry about it. This is just a normal retracement within a downtrend. We are still so far above the 50-day and the 200-day moving averages that it's almost embarrassing. It's going to take months of price action for this thing to even give hints of turning. And here we have consumer discretionary as a percentage of SPY. This is the beginning of 2007. Don't forget that we didn't have the complete drop in the indexes till 2008. This gave you advance warning a year ahead of time. XLY throughout 2007 was saying there is something badly wrong here. And then in 2008, it actually stabilized. So XLY over SPY is an advance warning. It is at the moment showing you absolutely no warning whatsoever. It's still in a steep uptrend. These are just small retracements within that uptrend. Nothing to be worried about here. And finally, here we have our favorite, which is SPY over IEF, IEF being the 7 to 10 year. Here we are. We're still very much in an uptrend, very much the 200-day moving average is going up. This is a weekly chart. You can see what happened here in 2007. In 2007, this started giving you advance warning. It went below the 200-day moving average towards the middle or third quarter of 2007, and then throughout 2008, it kept on absolutely getting hammered. And it gave you a buy signal in March of 2009. You found the low, and it crossed over the 200-day and never looked back. This is not anything like this picture here. Is going to take another few weeks and months of work to establish a lower high, which we could do, but by then the index is probably going to be way over 2700 when we do that, and then we will see. But we have all our markers. We don't have to decide now whether we're going to have new highs in SPY. Why would we want to do that? We just know that at the moment the downside is contained because none of the charts, and we have over 30 of them, of risk on, risk off, are giving you a risk off period. They're just saying we are in a retracement phase of an uptrend in risk on. And probably the spread chart that should give you or give the bears nightmares and the bulls most hope is XLF over SPY, basically the financial sector as a percentage of SPY, the total market. This is 2007, the beginning of 2007, and this much like XLY, and that's why we just still to this day cannot understand why people couldn't see 2008 and 2009 coming, because we saw them coming in 2007, and we were just scratching our heads saying, why is this market not collapsing? Why is this market not collapsing? Well, it did collapse. It just took a long time. And this is SPY. This is XLF over SPY. It was collapsing throughout 2007, 2008, and in March of 2009, a bottom, and then in June 2009, it actually went over the 200-day, but the market was so badly wounded it took a long time to recover. And let's move forward and see what it is doing today. Well, it is certainly not giving you any indication that we are in any trouble whatsoever. The financial system is just fine. It hasn't moved at all over the past few days and weeks. This is still a sign that interest rates are heading probably higher, yields are heading higher, and not for bad reasons. They're heading higher for good reasons. The economy is doing just fine. Stupid. To us, it is absolutely no surprise that the dollar, DXY, has had this pullback. You know that we said we are no longer bearish down here. We said we might get one or two more lower bottoms, but it's bottoming, and we are going to have a period of adjustment in the DXY, and it's actually a period of risk off. People are bringing money home, and that boosts the dollar slightly. We see it no higher than these levels around 91.70 to 92, and then we will have room for continuation leg lower. All this ties in with a period of now trading between, let's call it 2600 and 2750 in the SPY, followed by probably another nasty jolt lower when the dollar has another leg lower. But that is an ABC pattern in the stock market, as we indicated. that is not the start of a bear market. We don't need to think about it now. We need to buy the stocks when they get below 2600, and we need to sell them above 2600 and take advantage of the volatility that we are being offered. We absolutely love periods like this because people tend to throw the baby out with the bathwater. This is the baby, DBC. We are really looking forward to buying it around the 1540 area. We think that's going to be a wonderful investment for many years to come. We have our bids in around that level, 1540, and we want to hold that for many years to come. The other baby being thrown out with the bathwater is EEM, which is wonderful. You can see what it did, 200-day moving average, bang. It'll now probably trade into the 48s, 49s, certainly should not trade much above 50, and then it will probably come back down and trade all the way to the 61, which is around somewhere around 40, 41. Fill all these big breakaway gaps. Very much looking forward to that ABC all the way back down to that level, and then we think that actually EM goes on an absolute tear upwards. Our absolute favorite index, NQ, very annoyed that we missed it by 20 ticks, but what can you do? Very much a wonderful chart which shows the strength of the technology sector in the States. We've had 2 weeks of people panicking and throwing everything out, and we're not even below this growth trend line in the index, which has held all the way back from the lows in 2009. Very impressive. We hope that we get to test it at some stage. The Bollinger Bands are coming in saying if we undercut this low, it's going to be by very little, and these are areas to buy calls because the technology story in the US is by no means over. Do our opinions concur with what is happening in the bond market, which is the one that we always respect the most? Yes, we think probably we are now in a 260, 290, 95 trading range in the 10-year. We think it's going to take something quite special to break the 3%. We don't see that coming for quite a while. We think now the markets will just allow these Bollinger Bands to close by trading somewhere between 121 and 122, mostly in the futures, and then at some stage we have the next leg lower. But I think that the next good month, is probably spent in a 121, 122 range, just about in the futures on the 10-year. Let's have a look at what I wrote last week. Yes, we're still really sellers of bigger rallies, but now we are sellers of short-term vol. We are sellers of puts against our shorts, or even slightly in the money puts, because we think there will be a jolly good period of at least a month in which the market does absolutely nothing. The Bund and Bobble again should have a bit of a pause in their trend. We are short of Italy. We will continue to be short of Italy. We don't care. We'd rather lose money on being short Italy, but we think that Italy goes to 125 sometime this year, and we're not going to miss it for the sake of a couple of hundred ticks. It's simple as that. We wrote ES decision time for many. Many panicked. Some will sell, most sold. Some will hold and be forced to sell lower. Yes, volatility. That's the name of the game. You know what we think now. We are now 25.75 to 27.25. So we'll write it down. 25.75, 27.25 is the range. Play the range. Don't be silly. NQ will be the opportunity. We think we've missed it for now, but as we know, we think this is an ABC. If this is an ABC, we will get the C test in a few weeks' time, and that will be the huge opportunity to buy NQ for many, many years. Watch volatility. Any close above 1980 and you'll get very bad things happening very quickly. We closed above 1980, we absolutely collapsed. That is your indicator. Now if you return below 1980, you can shut your eyes and buy the world and you will not go far wrong. The super cycle will come, and this is the buy opportunity. We've been very patient. How patient have we been? 6 months or so. This is the opportunity. In the C leg, we buy the emerging markets like crazy and XLK, and that will set us up for many, many years ahead. The butterfly is the same story. We are looking forward to triggering that trade more than anything else. Thank you very much indeed, ladies and gentlemen, and tweet to you on Monday.